We're so glad to have such a full house this evening, so this is awesome. This is Donna Dable of Remax Professional.
Nice to meet everyone.
Donna, you've been in the real estate industry for
18 years. Yep.
18, so, and I'm Kimberly Kozelsky, and I'm a mortgage originator, and I've been at this since the 90s, so to speak. So, it is really enjoyable because I think we found nothing. I know through the years, the beauty of what we do is relationship build. You know, the internet is a powerful and it's a wonderful tool these days, but it doesn't replace a relationship. And when you think about it from a medical standpoint or anything else, when you're spending this amount of money, use the internet as a tool, but we just can't say it enough. Build something locally, because you really want to have that same person to ask a question to. You really want to have them guide you through the process, and you really want them to be with you not only through the end, but it's really nice, 20-something years in this, and Donna and I go to the grocery store, and we're there an extra half an hour because we get to see other people that we've worked with. And that's a really vested interest in our neighborhood.
Mm-hmm.
So, just gonna kind of set the stage. We're working hard to try and keep this in spec to you guys in the next hour. That I'm gonna open it up and we're just gonna talk a little bit about the process and who some of your players are. And then I'm gonna turn it over to Donna, who's gonna talk about the real estate and the realtor piece of this. You can ask any questions to Donna as it pertains to that, and then Donna will send it back over to me and I'll bring in on the mortgage piece. Always some delightful conversations around credit and what a lender needs. And then you can ask me anything, and then we'll finish it up if there's anything at the end. Kind of reopen it. So there's notes out there, notepads, our cards are in there, and we're just gonna kind of start it from there. I asked some of you if there was anything that in specifics that you wanted to make sure was covered this evening, so thank you guys for some of that input ahead of time. And as we're going through this, if you think that there's anything else that I'm not touching on, please bring it up at the Q&A, or ask if you can talk with us afterwards. That's what we're here to do. All right? We good? Okay. Real estate is by far the thing that you're going to spend the most money on, ever. Right? So you've got a couple of really key players as you make your way through a real estate transaction. Number one key player, sitting over here, is Donna and your realtor. The realtor plays a really key role because Realtor.com is a wonderful tool, but it does not give you all the specs and information on a property. By having somebody like Donna with you, she also goes out and she can help you find certain things that may or may not be coming up on Realtor.com. Things that maybe you're thinking about or not thinking about from the pictures and the location and the size of the house. Helps then you walk around and see these different homes. You're really going to want to have a realtor by your side when you do it, because she'll explain how some of that commission piece works. She negotiates that contract, and that's a really big part of this. Because of the last time I looked, there was 13 small print pages to a Pennsylvania agreement of sale. And she knows it inside and out. She helps, there's deposit money, and she's in charge of delivering those funds to the other agents so that you're not the one doing the running around. Also helps to manage all the different, what we call contingencies or inspections and things that need to go along. It's not just as simple as you can get a termite inspection report and done. There's a lot more that goes along with it. So they play a really, really big role. And somebody like Donna, they're so good, they make you feel like you're the most important person in the world. And we love having that. After Donna, one of the next key players is me, your mortgage originator, mortgage person. I'm the one that helps you with the money. So we help you get ready for that by doing what we call a pre-approval. You'll see commercials where you can do it on your phone in 7 minutes. It doesn't replace, and it doesn't even ask you all the right questions that you really need to do to get that investigated. We as your lender help you decide what's the right program, what's the right product. Because it's not just now, it's not about just getting in the home. It's really what's about in 10 years from now. Is it right now, and is it right then? We help you decide what is the best rate. We help you navigate through all the different closing costs. We help get the loan in the door, underwritten into closing. We take care of ordering the appraisal. Because we need a third party out there to say, is the price you're willing to pay a fair and reasonable price to pay? And then we come to the table, which is really important. We can't say it enough. You've sat through settlements where there isn't anybody there, but you and the buyer, and when you have questions, and it's really a great day, you want somebody that's there at the settlement table with you, going through all the different documents, explaining everything, and bringing it to an end. Other than that, you have 3 other parties that'll play a pretty big role. They're just not as upfront and vocal as your realtor and your mortgage lender, and that's their title company. The good part for you guys is title insurance is a must-have in the state of Pennsylvania, and it really is such an unknown to people, because people are like, what is title insurance, right? Title insurance is the only insurance that insures the past. If you think about it, every other insurance you get out there is for what? Something that could happen in the future, right? Health, car, dental. Title insurance says, hey, you're spending all this money on a house. I need to make sure that 2 years from now, because it's happened, somebody knocks on the door and says, yo, I wasn't the Mrs. Seller that was there. Or you go to refinance and you discover that there's an old mortgage on the title to your property. Title insurance plays a really big part. You just won't meet them until the very end of the transaction, and they're the ones that conduct the closing. The other big part of this is your home inspector. Somebody who's going to come in and be an unbiased third opinion that says, you love the house emotionally when you first see it. The home inspector is there to say, let me show you the reality. Maybe there's some things that you've walked by and didn't realize, that they can turn around and say, I know this wall looks yellow, but oh, by the way, this is something else. They play a really, really important role. And last but not least, one of the other parties involved is the appraiser. It's the only person that plays a really big role that you'll never meet. Because we order the appraiser to go out and appraise the property. They don't call you to do it, right? They're calling the agents. They go out to the property, you'll get a lovely 25-page document that details it out, but at the end of the day, the appraiser is there to say, is the price you agreed to pay a fair and reasonable price? Make sense? Any questions on anything we've covered so far? So, with that, Donna and your realtor are really the first stop in this process.
Yes.
So I'm going to turn it over to Donna if I can.
Sure. So if I meet you for the first time and you would come to my office and you would say that you were looking for a house, first-time home buyer, even though I'm saying I'm going to speak first, the first thing I would want to know is what you can afford to buy, because you need to know that too. Because we don't want to go to houses and find out that you couldn't buy it, or you could have gotten more, because you don't really know where that number stands. And yeah, there are some things, mortgage calculators and things like that online, but you know what, as when Larry came, we were talking about different types of mortgages, and depending on what you're looking for, you could find out how much do you really need to put down, or what maybe you want to back into a certain payment, and all of those things. We find that out in the pre-approval when we get that from Kimberly. And then we will talk about what it is that you are looking for, what area you're looking in, when you need to be in the house. Do you have anything else to sell? You guys are all first-time home buyers, I would assume, because we're here. And go through the process. We go through the offer. We look at what's called a CMA, comparable market analysis, so we make sure that we offer the best price for the house. Right now, if you were looking in Phoenixville area, the inventory is limited, so we have to look at how the prices are increasing in this community, and then give a fair offer. The whole process going through, which Kimberly talked about, the agreement of sale is 14 pages, and I did print out a sample, and you guys are welcome to look at this if you've never laid eyes on an agreement of sale. I'd be happy to answer any of these questions even after class. So in the agreement of sale, you're not only just putting in a price of the house, but other things that are negotiated are settlement date, and that's important to you as well as the seller. If it matches up, that's what we're trying to do. what things might be included in the sale of the house. Sometimes people ask for washers, dryers, refrigerators. Sometimes they ask for other things that aren't standard parts of the house. Then you can, everything's negotiable. You negotiate, once you have your home inspection and you find out some things are wrong, like Kimberly pointed out, oh, what is this? Was there a leak? You get to look at what's called the seller's disclosure. The seller fills out a paper, and I believe that's 11 pages, saying what they know to be true about the house. How old is the roof, the heating system, the hot water heater, a lot of the major components. Have you ever had water in your basement? Any leaks, anything that, you know, plumbing issues? All of that, you have to read that. That is part of when you put in your offer, that you have read that information given to you by the seller. So you have that. Your home inspector will have that information. They will inspect the house. Whatever the information comes back with, that's what you're negotiating with the seller. Asking things to be corrected, getting a credit for something. There are different ways to do that negotiation as well. So that's all part of the agreement of sale too. As we're going through all this, I will be helping you, guiding you through the process, getting all the paperwork done. You'll be applying for your mortgage. I'll always be there, even if in the background, making sure that all these pieces come together so that you get to the settlement table. Working with Kimberly as the mortgage company and all the other players in there. The title company, I work with them. I work with the home inspector. So anything that you need, I'll have that all together for you so that you don't have to worry about anything falling through the cracks to get you to where you need to be. That is the major part of it. So, do you have any questions so far?
I actually do have one.
Yeah.
I was a question, what if there's a major difference between what the seller's asking and the appraisal of the property? Like, it's a major difference, like, you split it in half, you, compare to the side, you walk away from the deal, like, how does that happen, like, as far as the appraisal comes to be different than what the seller's asking, like, this is offered too high, see how far you move down off it, like, basically, like, what's the gap, like, what's the difference, it's like.
Right, okay. So there would be different ways to handle that situation.
Did everybody hear the?
Did everyone hear the question? Yes, okay. So let's use numbers so it'll be easier for me. So the house is, they were asking $200,000 and you gave them $200,000 and the appraisal came in at 180. Right?
Right.
Okay. In that situation, a couple things can happen. The seller can lower the price to that's usually the first thing that happens, and that's because that's the appraisal, that's the value. And then that's your new sale price. Two, the seller might say, no, I don't believe that. I think that my house is really worth more. They can, on their own, get another appraisal. Then you can look at both appraisals. You might come to some terms between the two appraisals to get something to work there. Like if theirs came out at 185 or 190, so you can negotiate that way. Thirdly, if someone's like, I just love this house, I don't care that it's 180, they can, cash difference. And there's 3 ways that situation could be resolved. Or you could walk away.
Right.
Yeah, absolutely. You could say the value is not there, no penalty, no harm, no foul. If you deposit monies down, return to you. Yeah. Yeah.
Great question.
It was. Thank you. Any other questions about?
So is the appraisal price, will that automatically becomes the selling cost for the house? Like the seller can't stay at 200 grand for it?
The seller can decide not to sell the house to you at the new price if he doesn't want to. But does that become the new price? The new price becomes whatever the net person pays for it.
Okay.
Is the new price.
I didn't know if it was like a
Yeah.
legal thing, like they couldn't sell below what the actual value of it was. Or,
Above.
ask about, yeah.
Well, they can if that person, like I said, if they're in love with the house and they want to pay
Right,
the
okay.
cash, they can certainly do that, yeah.
Okay.
Mhm.
Yeah, and I think if I can add that it's such a conception out there that there is no unfair price. The price is whatever two parties are willing to
Right, exactly.
sell it for and buy it for. I get, but we kind of become the third person or the party pooper, right? Because we're the ones lending the majority of the money, right? If you were bringing 200, you wouldn't need us and it could appraise forever you want, right? It's because somebody has to come in there and get an independent third party to give what they call fair market value. And remember, that value's floating. Because if two other properties sell that week and two other properties sold for 205, that house could be worth 200 the next week, right? It's all about time stamping certain things. And we just have to come in and say, all right, that just becomes the new baseline. We can lend off of the 180. You can bring the extra 20,000, there's no wrong answer. It's just whatever parties are willing to pay for it, that helps.
And people can pay over asking price too, and as long as, again, cash is, for the additional amount of money, if the appraisal value isn't as high as they want it to pay, you can pay the cash difference, or, like Kimberly said, with the time stamping and everything, as more houses are being, sold over value, then that starts to change value. So the house might be listed at 200, it might sell for 205, and it might then appraise for 205, because they're gonna start to see from the time that it was listed till the time that they're getting the appraisal, that, yeah, that's where the market's going in that short period of time, so it changes that quickly.
And right now, you're seeing a lot of clients and transactions have multiple offers right
Yes.
now, aren't you?
Yes. Like 5, that's a big number. Yeah. Yeah, absolutely. Yeah, because we have low inventory right now, and we have a lot of buyers out there. So it's, when something comes up on the market and it's good, you gotta go for it right now, because, waiting doesn't, go well. But we have the spring market coming up, so we have more things coming up in the market.
It is, it doesn't feel like it's slowed down, though, does it? So.
No, but we'll see it. I think we'll see another surge now.
Yeah.
Yeah, absolutely.
What else for Donna?
I have another question. Does that process change for ready-made from already built homes as far as other ones that advertise about building home that's like being built or under construction? Does that process change as far as this, like say if you're looking for a home in a certain area but the house isn't built yet? It's already priced out, like, is that the same as if you saw like a house that's, already built and waiting for sale? You understand?
Not sure, but let me see if I can answer, see if I answer what I think you're asking me. So the process is always the same in searching for a house or getting a mortgage. The pricing of the house is different if it's new construction, only because when in new construction, they have a base price of a house, in different models. And they'll say, this Phoenixville model is 200,000. And in new construction, there's so many upgrades. So you'd have to factor in those things that you would want in addition to the base model to get your sale price. Once that's your sale price, then you're going to get your mortgage for that sale price. Does that answer your question?
Yeah, because you're speaking as a new home is rather one that's already like, established value.
Yeah.
This new home that's being built. That's what I was curious about, but you usually see, not areas so much, but like, home areas where like, the houses are being built as they're coming, like for sale, say you can get your house now, it's how that works as far as the houses are finished yet or done. If the process is the same as if a house that you see signed up, you just go in there like, that's ready to be lived in. I know the process changed, the house is being currently built, or if it was one that you can, live in turnkey the next day.
Yeah, if it's being built and you still have the options to choose options, then that changes the price. Yeah, sometimes what builders do is they build, spec homes, ready-made homes,
Right.
just in case you can't wait for 6 months for your house to be built. So they'll say, on lot 52, we have the Phoenixville model, go look at it, see if the upgrades that we put in there are what you want, and yeah, and so there's not a lot of negotiating price with new construction, it's just a matter of upgrades changing the price. Sometimes, if builders are slow, then they might do something like say, oh, you know, we'll give you $20,000 in upgrades, or right now we're gonna do a finished basement for, the, you know, the next, you know, 90 days or something like that to get people in. But in a resale, you have more negotiating room with the seller, absolutely.
Are there multiple offers on the table? So for instance, if I'm interested in a house and how do I know if my offer is like the highest or lowest that if someone is coming up so much ahead of me, do you have a chance to counteract someone else's high offer?
The way that that happens is based on how the seller wants to handle the situation. And most times when there's a multiple offer situation, the seller and the listing agent will come back and tell, like me as the buyer's agent, okay, my seller is saying just bring your highest and best offer. So, and then if I know I'm writing that for you, I always say to people, then I want you to offer what you will feel comfortable with if you win or lose. So like, they'll, like I win, did I win? Oh, I think I paid too much, you know, buyer's remorse. Make sure that's what you wanted to pay for it. Okay, you lost. Really? Because I would have paid a little, $5,000 more, $2,000 more, like, you had your chance, that was it. Now there is in the agreement of sale, there's also another form, and it's called an escalation clause. So if you want to use that, it works like this. The houses, we'll use your number, the $200,000 house, the infamous $200,000 house, and you want to pay $205, but you're willing to pay $210. You can write your offer and say, I just set myself up for doing the answer. You can say, I'm offering $205, but I'm willing to pay $3,000 over the highest price that is on the table, but my cap is $210. I think I said that right. So you have a cap, you still have your cap of $210, but not necessarily paying $210. You're just gonna pay a certain dollar amount over the highest one.
Okay.
Now, if the highest one is $210 or more, you're out. But that gives you still a little bit of like, I'm comfortable with $205, but I'm willing to go a little higher if I need to. And then that could be the one that gets you there. Now, again, when I was talking about negotiating things, price is only one thing. It is the big thing. But sometimes it's important to the seller. Maybe they bought another house. Maybe they're moving out of state, and they've got to be out March 15th. If you can do the March 15th, you might be the winner. You know, because the other guy said, I can't get out until, you know, March 31st, That's part of it. Maybe you didn't ask for the washer, the dryer, the refrigerator, the dog, you know what I mean? Like, you know, you didn't ask for all of those things, so they're like, you win, because we really didn't want to give away all those other things. So, you know, and that's the intricacy of like what between the buyer and the seller, and as Kimberly said, what's your house worth, what someone's willing to pay for it, you know, and then there's those all the little things that are going on inside. Maybe somebody will say, you know what, and then don't ever do this, somebody might say, I don't even want to do inspections, whatever's good with the house, my brother-in-law knows how to fix that, blah, blah. Don't do that. But, you know, that could be a situation where someone says, oh, okay, you win, you know.
Great, Les, you
You
win
sort
every
of,
day, right?
Yeah, but if you wanna do that, no, you don't. But these are the ways that, you know, you can possibly win other than just the price. But the escalation clause is something that can definitely come into play. But you don't ever know what the other one is. If there's two close ones though, like really, like, usually there's one that they thought, I don't know what they were thinking, like it's not even close, and it comes down to the two. Maybe they'll come back to you and say, look, we really like your offer, but, you know, can we change this thing about it, or are you willing to do this thing? So when there's a bunch of them on the table, it always gets narrowed down to two, usually, where they can play that out. Does that help?
Yeah, it does.
Good.
And if I may, I found, Jeff, but this is where we just can't stress it enough, to have somebody that does this full-time, and not only does it full-time, but is doing it for a sufficiently long time. You'll find that 20% of the realtors out there do 80% of the business. And these guys that have been doing it for a really long time, when there are those two offers and those agents know each other, there's real open dialogue. Not non-confidential dialogue, but there's very open dialogue that says something along the lines of the example that you gave, and they're much more likely to have open dialogue when they know that they have a really strong agent on the other side that is not going to turn around and take this aha moment in 3 weeks and try to come back on something else in the agreement to change the price or to get additional money. And that's a really big thing that you want to consider, so.
Absolutely. And if you do come into a multiple offer situation, it is good, like I will sit down with you and say what I think that, how to pose this the best way for you to win. And it's not necessarily always, like I said, the money. I mean, that is a big part of that. Because it depends on what the seller's looking for. Maybe it isn't really all about the money. Maybe it's about that settlement date. So, with the dog, yeah. Maybe they don't really like that. No, we love our dogs. But yeah, so, yeah. And like Kimberly said, and I've been doing this for 18 years now, so kind of seen most of the things coming down the pike and knowing how to handle it. Yeah, it's really nice.
So kind of continuing off of that.
Yes.
We were told that like when it comes to, multiple people putting bids into a home, sometimes the type of, like whether you have a first-time homebuyer's loan versus a more traditional one, that also influences the decision on the seller's behalf. Is that something you guys would like, is that a decision, like which kind of loan you would get would be like based entirely off of our personal finances, or would it be like advice from you guys whether like if we should get a traditional one versus a first-time homeowner's one?
And Kimberly can answer as well, because I think that's both of us. But I think that, first of all, if you get a loan as a loan, you both are qualified. But yes, they are gonna look at, what's called the buyer's financial. And if you look through that, they do wanna see a strong buyer. Now, traditional versus first-time home buyer loan, that, to me, that doesn't really mean strong buyer, not strong buyer. But they might look at the person who can put 20% down versus the person that puts 5% down. And I say that also with like the deposit monies. They want to make sure that you're not going to walk away. So if they see that you're putting a large lump of money down that you're risking, that you're serious about buying the house. Not that the other person isn't serious, but at that point, yeah, the seller wants to feel the most secure with the dollars down. But the type of loan is not the factor. Yeah, is that?
Fair point, because remember, when the type would not matter. But in the example of the appraisal, if that seller and listing agent know that we listed it at top of the market, crossing our fingers, and by golly, an offer comes in at top of the market, and meanwhile you have an agent on the other side going, I hope it appraises, right?
Mm-hmm.
I hope it's worth it. So if you had somebody who was putting 10% down versus somebody putting 5% down, and now the appraisal came in $2,000 less, there's a much stronger chance that from the seller's side that the settlement would keep going, right?
Mm-hmm.
Whereas somebody who's putting down the minimal amount, there's nowhere to move it up, right? So kind of seeing it from that side of the fence is really the only reason why. But if you feel so strongly about this house, we are seeing personal letters sometimes come back in to play. I don't hesitate anytime. If you really truly feel that this is where the school district you want to be, or there's an emotional element to it,
Sometimes,
let it be known.
that's another thing. Sometimes people who, I've seen this, like an older couple has lived in the house forever and ever, and they raised their family there, and they start looking and they find out that like this person has like a little baby, and then somebody writes a letter and says, oh, I wanna put a swing on that tree in the backyard and push the baby all day long in the sunshine, you win. Because they can do that, like, they're the seller, you know, if that's what they want to do, if they feel like that home of theirs is now going to be the home for you, that could be the person that wins, so sometimes it's not all about the dollar. Yeah.
We beat out a cash offer on one.
Mhm.
Full boat, highest,
Oh,
little
really?
amount down, because he was the athletic director for that school district. And he said, I'm moving into the school district. This is where I want to be. Right, so
he
there's.
won on the house with a loan versus somebody that came with
He did.
with a bag of cash and said, here you go, and they
He
said,
did.
that's okay.
Yes.
Yeah, okay.
So never count yourself out.
Mhm.
Just never forget that there's a seller on the other side too,
Mhm.
right? And so,
And the why.
and the why,
Yeah.
yeah. Anything else for Donna before I take it back?
Okay,
Done, okay?
back to you.
All right. Mark, you can skip that part.
I didn't get it anyway.
Thanks. Financing, always so many fun questions on the money, right? So here's kind of what I'm gonna cover for you guys here in the last few minutes is financing, what it means to you. Why do you do the things up front that we tell you to do when it comes to a pre-approval? The elements of the mortgage, the credit, the income, the assets. And then I'll finish it off on the different types of programs, first-time home buyer, okay? Pre-approved. You've all seen the commercial, right? They're standing in the house, they can do, right? That's a pre-approval. All it means is, you know, back in the olden days, we'd march into the office with all your documents and we'd sit down. You don't have to do that in this day and age. But I will tell you this, if I ask you what color this wall is, you'd probably say yellow, right? But somebody else might see gold. And it's really, if somebody else was looking for a different variation of it, it's really about the questions that you ask. And the more questions you ask, the more deep you can go. Much thing that I always say, if you're going in for a surgery, do they just say, I'll see you on Tuesday, right? They don't. They make you do all your blood work ahead of time. They get all your information, right? So that by the time you've walked in, you've done all your due diligence. This is much along the same lines. The more you sit down with a lender and you just say, I make X amount a year. Oh, really? Tell me more. Is it salary? Is it cash under the table? Is it self-employment? Is it bonus? Is it overtime? The more we break that down, the more we can help guide you. And the only reason because it's not like a lender just says 50, have a nice day. A lender has to say 37 base, 8 overtime, 2 bonus, whatever those numbers are, because there's times when you can use them under certain programs and there's times when you cannot. Does that make sense? So we've got to make sure that we've got that down. Then from there, we'll go through and we'll collect your pay stubs as well, because there's things that you might think of or not think of that we have to look at as well. So there's 2 options of a pre-approval, and here's what I don't want you to lose sight of. You've got the option where you can just go online and fill out the information. It's fine, but I just caution you, if you don't go below skin surface, then you're gonna get what you ask for, okay? You can call me and we can actually sit and take the information over the phone. We can meet face to face, whatever you want. And then I ask you those questions, and then I literally input it all and I run it through the system, and it goes right up into what you call into Wall Street, the secondary market, comes back and says 2 thumbs up, and we go. There are times when you'd say, me telling you that you're good and the system telling you are good, is really only half of it. Because at the end of the day, I don't get to sign off on your loan. Nor does your loan officer, nor does your realtor. It has to be signed off by the actual institution and an underwriter, so to speak, and you may not think that they exist, but they do. And so what happens, if there's what we'd say any skin, anything that we are absolutely not quite sure of, for example, the guy that's been in business 15 years, he's an HVAC guy, but last June a year ago, decided to go out on his own and do it. So there's a little rule in lending that says, gotta be self-employed for 2 years, right? It's not. Same line of work. So what do? We collected the whole thing like we had a loan on a property and everything, and we can send that loan in. And we can have it looked at by the underwriter. We can have it done. We can have you so ready to go that you could settle in 7 days if you wanted to. Well, I'll tell you what, now you're in a multiple offer, and we're saying to Donna, hey, I'll call the listing agent. Because if we both know them and you're multiple offers, we're picking up the phone, calling, going, oh, by the way, not only are they pre-approved, they're fully approved. We've gone through everything in the motions. And boy, does that really put you in a better situation. So I'm a big fan of option tool too, which is send it in, send it through, get everything signed off on ahead of time if you want. Does that make sense? So pre-approval, you're literally sitting down with somebody, sharing documents back and forth, and we get you an answer. Versus just going online saying an input of, here's my annual salary, here's my liabilities, here's the cash that I have. Do you understand where that difference can fall? And I don't know about you, but if you're out there shopping, you're about to write a check for a house, I want you protected. Okay so far? What happens with that? You get pre-approved, you get to shop with a little more confidence. One of the biggest parts of this is saying, here's what I think I want to spend on a monthly mortgage payment, but I'll go as high as this. Here's what I want to spend, but I'll go as high as this. One of the first things we do with you when we sit down is we say, practice it. If you're paying $1,200 for rent right now and you feel like you could do $1,700 for a mortgage payment, I want you to start it next week, March 1st. And you say, how? By paying yourself. You write the $1,200 in rent and you write an extra $500 and you put it in your savings account. How did it feel? It should hurt because you're not used to it. But if you did that for 60 or 90 days, it's amazing that by the time you go to look for a house with Donna, that $1,700 is either so embedded in your mind as that's really it. Or you know what? Donna, I think I could hit $1,900. Give yourself credit. If you've never tried it, how do you now? So that's one of the things I say is pay yourself first, practice. And oh, by the way, what happens if you did that for 90 days? You'd have almost an extra $2,000 in the bank, wouldn't you? Furniture, down payment, whatever it is, it serves a dual purpose. So it lets you really be out there shopping with confidence, because you can walk in and love all the fixtures in the house, but you run my little calculator and you're like, that payment's $1,825. It's not so pretty anymore when you can come at it with the reality. Oftentimes we go to pull somebody's credit and there's a surprise. There's something that you weren't expecting, something that you didn't know about. Don't wait to do this until you really want to go out on Saturday. I always say do it this 3 months to 6 months before you ever want to go buy a house. The worst thing that can happen is we're going to update your credit in 4 months. It's not going to hurt it. And I'll talk about credit in a moment. It can be updated at any time, meaning to you, if you go through the internet and you get a pre-approval for $200,000 and you're going out to look at a house and you're going to offer $195,000, why should you show the seller that you can do $200,000, right? So the beauty of having somebody local is you're picking up the phone and Donna's reaching out going, they love the house, we're going to make an offer. Then I update the pre-approval to match your offer. That makes sense. We want you positioned as well and as strongly, as consistent as we can. And as you heard me say, we've got the ability to not only do the pre-approval, but to do the entire loan without having an address. And that's a really key feature. If there's any part of it that you are uncertain about, let us help make you certain. Because when you're certain, I'm going to tell you right now, your first experience buying a home really sets the stage for the next 30 to 40 years to come. If you have a good experience, by the time you become the seller and another buyer, it's different than somebody who did not. They're very apprehensive about it, they're very gun shy about it, and they're very scared about it, and we want to take that away. Does that make, okay? Credit, income, and assets. It's really all the mortgage is. The reason that it's so much deeper than anything you've ever done, if you think about a credit card or a car loan or a student loan, that's $2,000, $5,000, $25,000, whatever that is. This is a six-figure number you're asking to borrow from somebody. So ultimately, a lender is required to go a little bit deeper than anything you've seen. And this is probably the hottest topic that comes up is credit. So you heard me say, I wouldn't wait. If you think you're 6 months out from this, call, let's get it run, so you know. Because what's in a credit score? And here's the analogy I always use. A credit score is nothing more than a football game with people standing in the bleachers. And they're either saying, they pay me, they're standing going, yay, or they're sitting down, they're not saying anything. Because if you think about it, did you ever have your credit pulled? What'd you give them to pull your credit? What'd you put in to get your credit score?
Social.
Social? What else?
Income.
No. No. If you think about it, if you go out on any of the websites, you put in your date of birth, your social, your name, and your address. Now, if you're filling out a credit application for a car or something like that, yes. But on any, like the Credit Karmas or whatever, it's not your income. Credit does not know what you make. Credit only knows what debts are there, when were they open, are they paid on time, and are they near their exposure? Right? So, you'll hear a lender say, we pull from all three major according. And we do that because it promotes fairness. You knock out the high score and the low score, and most of your debts report to all three, but there are several creditors out there who will not report to all three agencies. It costs them money to do it. So some will only report to one or two, which is why if you pull it from all three, you get a more balanced score. And anything you go get, like on Discover or like on my bank, it'll tell me every month what my credit score is. I have yet to find a consumer whose credit score when I pull it is the same as what you get through Credit Karma or your bank. And it's because of this. Remember, think about it. If the bank, you log onto your bank account every day and it says your credit score, right? Does that mean they're pulling your credit every day? If they did, where would your credit score be? Right? And people will always say, oh my God, Kimberly, don't pull my credit so much, it's gonna go down. And I'm like, oh my God, if that was the case, my credit score would have been perfect when I was 16, it would have been in the tanker when I was 80, right? That's not how it works. Credit just says, they expect you to be a savvy shopper. They expect you to look at more than one place. So that's all taken into account. But it says, what's the likelihood this person will pay you back if you give them money? So you gotta give them something to talk about. So we always say, people will like, I'm gonna shut down all my credit cards before I go buy a house. No. Because remember, it's saying, here I've got an account that's open for 10 years. If its balance is near its limit, because it doesn't know how much money you make, it says, is there a chance, is something up? Is something up that their cards are maxed out? It's a sign of trouble. If somebody opened 6 credit cards, does that mean they're trying to run around and open different ones? I don't know, but it's a sign of trouble. If you went late, it's a sign of trouble. And I will tell you the most common one that we see is somebody who answers the balance transfer. When it says, I'm gonna transfer all my balances onto a new card, then I'll shut down my old ones. No, because think about it, what did it do now that you have that knowledge? New account, maxed out, and all my other abilities shut down, right? So what did it do to my bleachers? It had them get real quiet. Does that make sense? Ultimately, the higher your credit score, the more programs and products that are open to you. Your mortgage rate is based on your credit score. And the best part I can tell you of what I have at my company is when I pull it, it'll also give me an analyzer. It'll say, hey, that credit score could go up 25 points. if they do this, this, and this. And we'll be able to tell you that. I'd rather tell you that 90 or 120 days before you want to go buy for a house. Because if I can help you move your credit score to a higher part of the bleachers, I can help you get a better rate. Does that make sense? So, biggest things that you can do to help keep your credit going or pay your bills on time, obviously. Credit does not show you late until you're over 30 days. So please don't take the time to bash each other and say, oh my God, what do you mean you didn't get to the mailbox or pay the bill online, it's due tomorrow. That's okay. It's not until it's over 30 days. This is the biggest one. If you went and opened the Target card at Christmas to get the 10% discount and it's got a $500 limit, please don't keep a $400 balance on it. Try and keep your credit cards at a limit and a balance that's at least 50% of the limit or below. That is really a key factor in your credit score. Because remember, it doesn't know what you made. It just knows that my debts aren't even half of my borrowing ability. Does that make sense? Make sure your records are accurate and to protect them. Here's one of the best parts that you'll learn from me tonight. You're entitled to a free credit report on yourself every year. Did you know that? How many agencies did I say there are? If you figured it out, every 4 months you could go to a different agency and get your credit report, couldn't you? So you could act as your own credit monitor. You could do one in January, one in May, and one in September, and voila, you're constantly keeping track of your credit. Do it, it's fun to be able to see, you just won't see your score. And be careful not to apply for too many loans or credit cards at the same time. Does that make sense? You heard me say, don't close your cards. This is the only time that anybody is going to be poking and prodding around in your credit and your assets and your income to that point. I promise, once we're done, we're out. The only time we're in is when you call me in 6, 7 years and tell Donna I want to sell the house now and get something bigger and we'll be back in. Till then, you're back there. You heard me say, just be careful. Don't open the new cards. Don't balance transfer. Let it sit. Let us take the snapshot. Let us give you the ideas of what you're able to do with it. And then did you know that if you shop multiple lenders over a 30-day period, it is not impacting your score? I'm fine. You can get more than one pre-approval. Absolutely fine. It's you going through the diligence, and I think you'll find that sometimes if nobody asks you a question versus somebody that asks you 5, don't be offended by the person who asks you 5, you get back more. Okay? And then you heard my notion on the annual credit report. Any questions so far? Credit's always a juicy topic.
You know, one thing I was just thinking of, when you are under contract purchasing a home,
Mhm.
and then people go out and buy furniture during the contract. You wanna talk about that, because
Sure.
then that changes, okay.
Good point. A lender is required to do like a monitoring behind the scenes up until the day of settlement to make sure that nothing has changed with your credit or your job. So as much as you want that refrigerator from Lowe's, you can go as soon as settlement's done.
Yeah.
Now, if your credit, if the credit's healthy enough and the debt to income, we don't care, but I don't want a question for you. Does that make sense? I don't want an 11th hour question. We want it done and smooth for you. Good take on. Any other questions on credit? Did I cover a lot? Then the second part of us is the money. It's always say, show me the money. Income's a big part of it. I've yet to find a borrower who, they get a bonus and then they're feeling like that's the best time to go find a house. Can I use that bonus as income? Sometimes, absolutely. But I can't assume that that's going to be the bonus every year and just hike the income by 25 grand. I can use that bonus as cash down all day long because it's in your bank account, but I might not be able to use it as the income. So you can expect a lender is going to create a 2-year income history on you. It doesn't mean that I collect 2 years of pay stubs, but you can expect that I'm going to collect the most recent pay stubs. if you have any ancillary income such as overtime or bonus, write this down for me. I'd go into your HR system now and I'd get your December 27 pay stub. I'd even pull your December 2016 pay stub. Because then that's gonna give you the whole year breakout. Because did you ever notice on your W-2, does it break anything out? No. It just says, here's your salary, or here's the income to report to the government. So those are the things that you can have ready for me or your lender, because then if we can pinpoint your income with accuracy and not guess, we better protect you. So some HR records will only keep them available for you for a certain period of time. So that's why I always say if you can go in and PDF your December ending pay stubs for the last year or two, boy, you're really ready. There's a big question of if I'm self-employed, can I ever get a loan? Yes. Right, this is the best time of the year because I know I have one self-employed, anybody else that's self-employed? Beauty of what you do. There may be things that you don't have to pay to Uncle Sam that Aunt Kimberly does. But this is the only time that you see the other side of that coin because if you have the ability to move income from a taxation purpose, isn't always the ability to use it for a mortgage qualifying purpose. So especially this time of the year, if you're thinking that this is a venture you want to take in the next year or two, before you get your taxes done, have a sit down. We could say, all right, if you stay on the constant, that's where we go. If it's going up, here's the impact to it, because you don't just get to use a higher number. So we can kind of walk you through all that. Anybody have secondary jobs? 2 jobs? Happens all the time. Sometimes you can use them, sometimes you can't. It really depends on the loan program and product. So by virtue of us being able to sit down and ask those questions, we can help guide you. Any other questions on income?
I was just gonna ask you to sort of elaborate on the whole, like if I got like a part-time job on the weekend, could I use that?
The most products out there will say, we love when somebody gets a second job, right? Because it shows that they're trying to increase their revenue stream. The likelihood that someone keeps a second job or their full-time job, which one do you think there's a bigger likelihood that you're going to keep? Full-time job, right? So generally they're going to say that on average you gotta show a 2-year history of having a second job. They consider that long enough that somebody's sticking with it. How about seasonal? Anybody do seasonal? Shoveling, all of that? Same thing. You can only work 2 months a year, but if you've done it for at least 2 seasons, that's generally considered like a second job. So, fine all day long. I know nobody will raise their hand, but if you get paid cash under the table, can you do that? Sometimes. Under certain programs, we will allow cash on hand, especially for anybody in the service industry. There are certain ways that you can go about that. Does that make sense? Great question. Anything else on income?
I have a question.
Yeah.
You said they pull about 2 years. If, would you get, I guess, more leeway, or better to say 2 years versus 10 years if you've been coming for a longer time? Does that factor in as far as the longer you've been in, which is 2 years? Okay.
That's the only thing we're gonna document. But I will tell you, in this area, we are really lucky because we have a lot of employers with longevity of their workforce, more so in many other areas, many others. So it factors into the overall health of the transaction versus somebody that's been at 4 jobs in 2 years. But no, we wouldn't go back any further. Okay? Good question. Anything else? Income's not usually nearly as fascinating as credit. But the last one are assets. So you got 3 things. You gotta qualify from a credit standpoint. You gotta qualify from showing that you can carry it on a monthly basis, which is the income. The last part is you gotta show any of the money that's being used for the transaction through assets. Big thing. Please get with somebody when you do your pre-approval and give them your bank statements. It's not because we want to see if you're going to Dunkin' Donuts. Doesn't matter. Doesn't matter. We all are. What we want to see is certain triggers that while you may have a certain way of budgeting, it just may not be a certain way that a lender has the ability to show it. What do I mean by that? Two people live together, probably one person's on the lease, so I pull cash out every month and I give them cash to cover the lease. That's fine, except that you're depositing all sorts of lump sum cash in the bank statement. Even though you're buying US real estate, the government says you can't use it cash unless you can document the source and the trace. Thank you, terrorist acts, that's why it's from, don't take it personally. They just say, if you can't prove the US money, you can't use it to buy the home. So if we know that by looking at the bank statements going, hey, I see $750 in cash, tell me about it. Because if we do that before you want to go buy a house, then we can maybe change that. We can help you say, can you write a check? If I'm using both of you and you're both on the loan and I can show it's an automatic transfer from one account to the other. Okay. Does that make sense? But we can help change your course in ways that won't become such a pitfall or a source of consternation through the process. Other assets, what's that mean to you? 401k. You've got a retirement account to use all day long if you want. Pay yourself that. And not anybody else. I will tell you there's one source of other assets that rears its head periodically, and that's somebody thinks that they can go take an advance on their credit card, put it in their account, and they're good. The answer is you are not. There's no product out there that is a traditional mortgage product that says you can borrow from a credit card for a down payment. 401k all day long.
So you can borrow from your IRA 401? Up, like what percent of that, of the total that's there?
That would vary, but there are different types of withdrawals if you are considered to be a first-time home buyer. And the answers are different on a 401k than they would be in an IRA. I can tell you on a 401k there are hardship withdrawals and there are first-time home buyer withdrawals. And I've seen the number go up to $50,000 in a 401k. I can't tell you on an IRA, but I could go try to look something up in the
And obviously
tax
that's
code.
another penalty, obviously.
Correct. Because but you can only do it for a house, first-time home buyer. Gifts are probably the most common type of other asset that flows in. Now's a really good time to ask friend, family, if they're planning to gift you. Because there's a really big thing that can happen. And I'll tell you, we are never here to entrench on family members who are kind enough to give you a gift. But if that gift is in your bank account before you come and sit down with me for pre-approval, the process that I have to put your family members through is much less. Do you understand that? If it's there by the time you come to sit with me, their steps are less. And to me, that's valuable to somebody who's being kind enough to give it. Versus if it flows into the transaction after the date time stamp of my pre-approval, the steps that parents have to go through are more. So, big part of something that can help. More than that, I would say the most common piece that I get is, you millennials, please check your bank accounts. More times than not, you forgot to change your address because they're never mailed, they're electronically delivered. And it's 2 addresses ago. It may still have a parent on there because they put themselves back on it when you were 17 and you've never taken them off. So give that kind of stuff, just give it your set of eyes right now. Because if it's not your address, it prompts a question. So let's clean it up. A lender should ask you for no more than 2 months. Very few exceptions when it can be 3, but the last 2 months of bank statements. So I always say, if somebody else is living in the house with you and you trust them, look at your bank statement, put it out on the table with there and say, look at it, forget my name's on it. Could you tell where my money is coming in and going out? And if they can, you're in pretty good shape. But if they look at it and say, wow, what's that? I don't understand. Or it's a cash deposit, and if they can't know, I'm not gonna know either. A lender does not care what you spend from your account. A lender only cares what you bring in. Okay? Okay to keep going? So let's say we get through all those. You say, Kimberly, what's the best program for me? And it really comes down to, those are your big ones. Your big ones, the most common, are your traditional, what you call traditional loan, and your government loan. One of the things that we sit down together and we go through the pros and cons of each. There are absolutely reasons when one would be better for you than the other. The only thing I will tell you is you're gonna make sure that you sit down with your lender first. Once they have all the aspects of the income, the asset, and the credit, then we can help guide you. But I will tell you the most common, if you can do it, is your traditional conventional loan. They come in with as little as 3% down. 3% down. Whereas the government loan is 3.5% down. But there are absolutely reasons that we turn to that, such as if all the money was being gifted to you, or our credit score needs a little bit of strengthening, or we need the seller to help with closing costs a lot more. Those are reasons that we would choose one side of the aisle versus the other. And the best part is, please, at your pre-approval, we don't decide it. We don't have to decide it. Sometimes it's not until the property comes in and we know what that looks like that helps us really decide what is the best product for you at that time. So again, being with somebody that you can pick up the phone and call and walk through versus an 800 number, I'm not here to diminish them. But I'm here to say you guys are important. You're not important just at the beginning, you're important the whole way through. Make sure you partner with somebody that's there with you the whole way through.
Because that USDA loan depends on the property.
USDA is the third most common. USDA is delightful because you can put 0% down. But USDA is very driven on the geography of the property, and there are income limits. So don't walk away going, I know I can put 0% down. There might be times when we'd say, that's an option. Okay? Otherwise, as you said, can you build a new house? You can build a new house all day long. Is it still a mortgage? Yeah. The only thing different is we're just not gonna deliver it to you for 9 months. Kind of like having a child. Right? So we have ways of where we can lock in the interest rate for a longer period of time until it's done and ready to go. Could you find a really great buy in Phoenixville right now, but say, I love this property, I love this area? There are a lot of great ones right now, and to Donna's point, where somebody's been living in there for 40 years and it just really needs updated. Did you know there's loans out there where you can come in and buy it for this price, and the improvements we tack onto it, and we'll lend to you based on the value of when it's gonna be done? It's called a renovation loan. They're phenomenal. Phenomenal. A lot of extra work for you at the front end of it, but absolutely worth it. Because you can be at the house and bring it up to really what you want, what you can see. You know, and hence where the HGTV shows came from, right? You can see it, you know, but it doesn't go that fast, I promise. So other than that, you've got some condo projects that are coming up in this area, all there. It doesn't change anything. Just recognize that when you start your pre-approval and what you ultimately may end up may differ because of the property you buy, or the price that you get, or the taxes that are on it. Does that kind of bring it home a little bit for you? Right at 8, sorry. So that kind of circles me home on the mortgage piece. What questions do you have from there?
For the renovation loan,
Yeah.
when do you begin repaying the loan? When you finish the property? Or I guess, how much do you pay up front, and then what is your payment after you finish? What is the mortgage?
It's a great question. Did everybody hear that? So, $200,000 house. You do $50,000 worth of improvements. We come in and we get an appraisal that says it's gonna be worth $250. You know, it can't be worth $230 because you're putting a sauna in the back. right? So we come in and we lend at settlement. You still go to settlement with a $200,000 sales price, but we've lent you based on $250,000. So the mortgage payback starts the first month thereafter.
When you finish
Based,
the project.
no, it's still like a house. Remember, you still bought a house. So your mortgage payment is the first month thereafter. Because we've still dolled out all $250,000. But part of it has gone into a side account to pay the contractors as it's getting done. And $50,000 in renovation, they'd probably be done, in a few months. So, yes, whereas if it was a construction loan, and we started with an empty lot, and it took 9 months to build, then your answer
Okay.
is different.
Gotcha.
But on a renovation loan, it's gonna start from day one. Because we've dispersed it. Good question, and we don't see enough of that around here, honestly, and it's a great way to do it.
Can you do the renovations yourself, or it has to be a contractor?
The answer 99.9% of the time it will be a contractor.
Just
Okay.
because the amount of work that has to be done, or just the skill level to do it?
A lot of it would have to do with risk,
Okay.
because if I just handed you a $50,000 check and said, God, I hope he does the improvements that he said, but you could run off with $50,000 of my money. So it's really a risk factor, not to mention if I hand you $50,000 and hoping that you do it, but oh, by the way, you're gonna do it really fast, but that means you probably stopped working your other job to do it, right? If you did it. So if you're a general contractor by trade, then you got a better shot of us saying you can do it. Okay? What else? Who wants to buy a house in the next year? Yay,
How
thank
would-
you.
Oh, I have a question. Both though. But how is it different if you're not married for the loans?
What an
And everything?
excellent
Is it
question.
just who makes more money, they go on
No, you can both go on the loan all day long. All day long. Here's what I ask you to think of, just write this down for me. Kimberly said, Google tenancy, T-E-N-A-N-C-Y. Tenancy, T-E-N-A-N-C-Y. If you're married, you hold the property as husband and wife, end of story. If you are not married, you have the choice of holding it as joint tenants, which means please don't let something happen to the other person, but if it did, it passed to the other person. Or you have the right to hold it as tenants in common, which means please don't let something happen to the other person, but if it did, it would go to the heirs of their estate. And when you were sitting at our settlement table, that is not the time that I want you to decide the answer. Especially, and I'll tell you why. If your significant others, one of their family members is gifting funds for the transaction, please understand that they may have every right to, as much as the significant other cares about you, that they may say, listen, I put the money out for the house. I really want it to go to my child's estate. Until you're married. It's not an unreasonable thing to say. So I would rather that you have those discussions, and nobody's ever gonna tell you to have that discussion, until you're at the settlement table, they'll be like, yeah, what do you wanna do? I don't know. So if you just invest the 5 minutes of time, it really gives you some confidence,
Yeah,
but.
The title company, our
They will
title
go through
company
it.
will ask you that before you get to the settlement table, so
That-
you know. And Laura's awesome, so she'll explain all of that to you, and then you can make the decision of how you want to take title, which is different from mortgage. Taking title and paying the mortgage are not the same
That,
thing. Yeah.
Here's the only other piece, please be aware of if you are not married when you buy the real estate, and at some point there's a dissolution, and ultimately someone would generally have to refinance that mortgage to take the other person off of it. It's not like you can just say, all right, I'll see you later, I'm gonna deed you off. You have to then redo the mortgage. And there's some transfer tax involved. Whereas if you are married, that is not the case, so. But otherwise, you can do it all day long. Okay?
Did that answer your question?
Yeah,
Yeah,
thank
but-
you.
Okay. What else?
I have a question, I'm sure we covered as far as like other costs besides just the price of the home that you may incur or see. I guess, additional effect on that.
Would love to, It'll take me just a couple minutes, am I okay? Everybody has to go, I know I'm running over, am I good? You have 3 segments of money. Number 1 is down payment. That one's pretty easy for you to figure out. The price of the home is $200 and you put $10,000 down, that's a $10,000 down payment, all right? Number 2, I call them buckets. Number 1's a bucket. Number 2 are costs that are associated with the property, doesn't matter who owns it. You're driving down the street, you see a house on the right, what do they paying there besides a mortgage? Yep, taxes and insurance. In the great state of Pennsylvania, we pay our taxes on a yearly basis and we pay them in advance. So you can fully expect that now that you get knowledgeable on this, you're gonna look at the price of the home, and then second, you're gonna go look at the taxes. Because you can look at 2 different houses and they can be the same price and the taxes are different, so it's a whole different payment. So a year's worth of taxes are going to change hands on the day of settlement. That's bucket 2. That's the bucket that will change the most on you through this process, believe it or not. Because those taxes could be $1,000 different, one property versus the other. That's $1,000 different in closing, okay? And the mortgage payment. Biggest question I'll get from a first-time home buyer is, yo, Kimmy, how about we settle in December and I can scrap having to give a year's worth of taxes and insurance? And the answer is, it won't work that way. A year's worth of taxes is still going to change hands. Where it goes changes, but it's still a year's worth of taxes. Does that make sense? Bucket 3 are costs that are associated with the sale of the house between a seller and a buyer. One time and done. In Pennsylvania, we have a transfer tax. You can mostly expect that you're gonna pay 1% of the price of the home as a transfer tax. There are exceptions to that rule, and there are about 33 of them in the state of Pennsylvania, but the closest that you'll probably come to it is if anybody looks into Tredyffrin Township. It's really about the closest one to here until we get up to Berks County. So just for the most part, say it's 1%. And then remember when we talked about the other parties and we said the settlement agent, the title company? Way back at the beginning, that you don't normally meet them till the end. Title insurance is your second biggest one-time cost. Lucky for you, the state of Pennsylvania sets it. It's pretty expensive. A $250,000 house, it can probably be about $2,000, $2,500 all said and done. But it doesn't change much on the price. So if the transfer tax is 1%, whether on a $200,000 house, do you agree my transfer tax is $2,000, right? If I spend $210,000 on the house, what's my transfer tax? Where's my math, guys? $2,100. How much did it go up? 100. Is it gonna stop you from buying a house? If my title insurance was about $2,000 and my title insurance went to $2,100, another $100 difference, is it gonna stop me from buying a house? No. But if my taxes are $1,500 different a year, that might stop me, right? So bucket 3 are all one-time costs, and then I end up in bucket 3 for what you gotta pay me for the appraisal, our flat fee, anything along those lines, okay? So that's the cool part, is when we sit down, we kinda get to show you how that doesn't change too much and how you can run different scenarios. So it's really pretty cool, because it's easy once you get the baseline down, and it'll take away some of the fear, and then we'll start showing you how we can do things without money. And that's where it gets really cool. But great question. Anything else?
So if you're paying years worth of taxes for the future, like if I buy my house in March, I'm paying taxes through March 2020, like upfront.
For the most part, but no, but yes. So the question is if I buy in March, am I paying taxes till next March? And the answer is, not really, but we'll explain it this way. Let's just say that my taxes are $2,400 a year on the house, right? About 75% of my tax bill is school taxes. About 25% of my Pennsylvania real estate tax is local tax. Local runs on a calendar year. So if we settled in March, the sellers probably already paid my taxes, their whole tax bill for all of 2019, because it was based on a calendar year. So if you settled in March, for the most part, you're gonna be reimbursing the seller from March till December. So you're not technically paid through till March of next year. But that's only 9 months, right? And what did Kimberly say? I'm gonna pay a year. The other 3 months, Kimberly's gonna set aside into an escrow account, because guess what? You're gonna make about 9 months of mortgage payments before that bill comes out in January 2020. So I need to make sure I have you with 12 months in there, so I'm gonna start with 3. You're gonna add 9, and bam, by the time the bill knocks on your door next January, I had a year's worth set aside for you. Does that make sense? Whereas the school bill runs like a school year. So the seller, if you settled in March, really only paid them through June. So you're gonna have to give the seller much money, because they're about done paying them. But guess what? You're no sooner gonna make a month or 2 of mortgage payments, and bam, that big bill's gonna hit your door. So I've gotta put 9 or 10 months away to stockpile on the side, because you're only gonna make a month or 2 of mortgage payments before that bill hits your door. Does that help to answer it? Okay. It's all fun. All you have to remember is a year's worth, and we'll help you carve it out from there, but anything else? Helpful? If there's something else, like if you want us to do a conversation or a follow-up class on breaking out all those numbers, we'll be glad to come back and do it. We love doing those. If there's a section of the agreement of sale that you want to understand more of, if there's a different topic that you want to know more about, just let us know and we'll talk to Mark, or please let Mark know. This is what the library is here for, is to benefit the community and its members. And what we think would be an important topic to you may not be the topic that you want to know about. So please, give that
And if you
feedback.
want me to send you a copy of what an agreement sale looks like so you can read it, because it's, when I first meet a client, before we even go to the agreement, I give you this anyway, because I don't want to wait until you get to writing an offer to know what this even looks like and going through all of that. So it's nice to, and then if you have questions about what does this mean, or what is this section about, and there's a lot of things in the agreement of sale that, I may only check a little box down here, but this is all the explanation of it. So there's a lot of stuff that you need to know, what it is that you're signing or what that means. And then once you've read it and go over it, I'll certainly explain it to you. So it's not your first time looking at it. I think that's important to have. Also, when I put that sample of the consumer notice in there for you, so if you guys ever go to like an open house, the agent should have those there for you. It explains agency. So an agent can be a seller's agent, a buyer's agent, or a dual agent. No agent represents you unless you have signed something that says that you're in a contract with an agent and they represent you as your buyer's agent. So if you go into an open house and there's an agent sitting there, you don't want to give them, show them your cards, right? You don't want to give them information about you. They don't represent you. You don't want to say things like, I need to be in a house by the end of May because, my lease is up. Because if you end up putting an offer in on that property, that agent now knows that information about you that you've given for the seller to say, oh no, don't budge on the price because she needs to be out and she's probably going to go ahead and do that. It's a situation like that. So you don't want to give them information like that about you when you go into an open house. Or other situation, that's the only other situation I can think of. Or even if you met an agent and they were showing you properties, unless you're in a contract with them, keep your information to you because they don't have a duty to keep that private unless you're in some type of agreement with them. And on that note, so you got the seller's agent, obvious, the listing agent, the buyer agent, person helping you. Dual agency is that same person doing both sides of the transaction. So there's the listing agent, you come in and you're working with them. And a lot of people don't do that because then there's that trying to keeping the private information of the seller, keeping the private information of the buyer, and trying to make those two things connect and having that, information separate. That's what dual agency is. And the best part about the buyer's agent is you don't pay them. So if you have a buyer's agent who has all the knowledge and all the experience and all the education, they work for you and you don't pay them because the seller pays the commissions to both the listing agent and the buyer agent. So there should be no reason why you would not want free expert advice going through the process of buying a home. Find someone that you trust, someone who's been doing it a long time, someone who has the experience, the knowledge, knows the market, where you're going to be, and is, put your interests, above all, and you know that you can, rely on them to help you through the process.
Donna and I live right here in your neighborhoods. We're
Mhm.
both right here in the area.
Yeah.
Her office is in Exton, but she lives right here in the Phoenixville area. My office
For
is right on
25
Morgan
years.
Street, so I'm right down the street.
Yes.
So we're both right here. We do this because it's good for the community. And it's just great.
You can
Thank
find me
you.
more in Iron Hill than you can.
There you go.
That is very true, guys, so, yeah.
Support your local,
Right.
support your local businesses. So, no, but thank you so much for the investment of your time.